Last week, I talked about what I called the Great American Housing Mismatch. We have homes, we have buyers, we have sellers, but the price, payment, location, and type of housing aren't always lining up with the people who need them. And while I was putting that episode together, I kept coming back to one particular part of the problem. Sellers are holding on to yesterday's prices, while buyers are waiting for tomorrow's rates. And neither side seems particularly interested in meeting at today's numbers. So this week, I want to pick up exactly where we left off, because if last week's question was, how did the housing market get so mismatched? This week's question is, what finally breaks the standoff? My name is Mark. Welcome to the Gentleman Broker Mortgage Brief. Let's start with where the market actually is today. Existing home sales fell another 1.7% in July. That puts the annualized pace at roughly 4.06 million homes. We've essentially been stuck around historically low transaction levels since mortgage rates jumped in 2022, and yet home prices nationally haven't collapsed. The median existing home price in July was about $434,000. That's actually about 2% higher than a year ago. So think about what's happening. Transactions are struggling. Buyers are pulling back. Mortgage rates are elevated. Homes are taking longer to sell in many markets, and yet nationally, prices are still hanging on. That's the standoff. And I think there's a psychology on both sides of it. Imagine you're selling a house. Your neighbor sold for $550,000. The house around the corner just sold for $565,000 last year. Maybe Zillow told you that your home was worth $575,000 at one point. So when someone comes along and offers you $515,000, or when your realtor says it's worth $515,000, you don't necessarily think that's what the market says my house is worth. You think I'm losing $50,000, even if you never actually had that $50,000. That previous value becomes anchored in your mind. Now let's look at the buyer. They see a $550,000 house. They see a mortgage rate of around 6.5 or 7%. They calculate the payment and they think, there's no way I'm paying that. Maybe they've been told rates are coming down. Maybe they remember friends buying at 3%. Maybe they're waiting for the Fed Reserve to do something. So the seller waits for a better offer. The buyer waits for a better rate. And sometimes nothing happens. And we're seeing this exact standoff right here in Washington. For Washington State, active listings in King County are up about 24% from a year ago. In Snohomish County, they're up about 35%. But at the same time, pending home sales across the Seattle area are down roughly 16%. Think about what that means. More homes are available, but fewer buyers are actually putting them under contract. Simply adding inventory isn't automatically solving the problem. The houses are there, the buyers are out there, they just aren't agreeing on the numbers. And that is the standoff. There's an assumption in real estate that eventually sellers have to lower their price, but that's not always true. A lot of homeowners have enormous amount of equity. Many have mortgage rates below 4%. Some own their homes outright. And unless they're moving because of a job, divorce, death, financial hardship, or some other major life event, they may not actually have to sell. And we're seeing evidence of exactly that. Earlier this year, nearly 6% of listings nationally were simply pulled off the market without selling or going under contract. That was near the highest level we've seen since the pandemic began. Think about what that means. The seller tested the market, the buyers gave them an answer, and the seller basically said, no thanks, I'll stay, I'll rent it, I'll try again next year. That's one reason this market has been so stubborn. Normally, when demand weakens, you expect prices to fall until demand returns. But if the seller has a 3% mortgage and substantial equity, they have something that many sellers in previous downturns didn't have: time. And time gives them negotiating power. Now here's the other side. Not every seller can wait, and we're increasingly seeing sellers make concessions. Recent data found approximately 46% of sellers gave some type of concession to the buyer. That's nearly half. And even more interesting, about 16% of transactions included both a price reduction and a concession. That's important because sellers may not always be willing to slash the headline price, but they may be willing to help make the transaction work. Closing costs, repairs, rate buydowns, credits, and depending on the buyer, those things can actually matter way more than another small reduction in purchase price. I've talked about this before. If you're buying a house, don't become so obsessed with winning the negotiation on price that you ignore what really matters: your total cash to close and your monthly payment. Sometimes $10,000 off the purchase price is valuable. Sometimes that $10,000 used towards a seller credit used strategically is much more valuable. The right answer depends on the borrower and the deal. But that's exactly what an adapting market looks like. The seller doesn't necessarily say, my house is worth dramatically less. Instead, they say, what do I have to do to make today's buyer able to purchase it? If you want to see what happens when a seller can't afford to wait, look at home builders. A home builder can decide not to sell. A builder really can't. They've purchased land, they've borrowed money, they've hired and paid contractors, and every completed house sitting unsold represents capital tied up in inventory. So builders tend to respond to changing markets faster than individual homeowners. And right now, they're responding. In July, 37% of builders reported cutting prices. The average reduction was about 6%. And 63% of builders were offering some type of sales incentive. Nearly 2 out of every 3 builders surveyed are doing something beyond simply putting the house on the market and waiting. They're buying down rates, they're helping with closing costs, they're reducing their prices, changing up floor plans, building on smaller lots, building smaller homes. Because builders can't control the mortgage market. They can't make the 10-year treasury yield go down. They can't make the Fed Reserve do what they want. What they can control is the product they're selling and how they structure the transaction. I think that's an important lesson for the rest of the housing industry. Now let's talk about the elephant in the room: mortgage rates. As I record this, Freddie Mac's average 30-year fixed mortgage rate is around 6.7%. And we've been hearing some versions of the same conversation for years. Rates should come down. The Fed is going to cut. Inflation is improving. The economy is slowing. Wait till next year. And sometimes rates have come down and then they've gone right back up. That's because mortgage rates don't simply follow the Federal Reserve. They react to bond markets, inflation expectations, economic growth, government borrowing, energy prices, geopolitical events, investor expectations. All kinds of things that neither you nor I can reliably predict. So I don't want to make another mortgage rate prediction. I want to make the opposite argument. Stop building your housing decision around a rate that doesn't exist. If rates eventually fall significantly, great. That creates opportunities. Maybe you refinance. Maybe affordability improves. But if the only way today's purchase makes sense is because you're assuming you'll refinance it into a 4% loan next year, then today's purchase doesn't actually make sense. You're financing a house with today's mortgage, not tomorrow's. Now, this is usually where somebody in the real estate industry will say, well, historically, a 6 or 7% mortgage really isn't that high. And technically, they're right. But I don't think that's particularly helpful because today's buyer isn't buying a 1987 house at a 1987 price. They're buying a 2026 house at a 2026 price with a 2026 property taxes and homeowners insurance and HOA dues, childcare costs, grocery bills, and a 2026 paycheck. So telling someone that their parents paid 10 or 12% interest 40 years ago doesn't make their current mortgage payment very affordable. Affordability is a relationship. It's the relationship between income, price, interest rate, taxes, insurance, debt, and household expenses. You can't isolate one of those numbers and declare housing affordable. And that's why I don't particularly care whether 6.5% is historically normal. The better question is, can today's household afford today's house using today's numbers? That's what matters. If rates stay elevated long enough, sellers aren't the only ones who change. Buyers do too. Maybe the first house isn't as large. Maybe the location needs to change. Maybe the buyer needs to put down more money. Maybe they buy a townhouse instead, or maybe they need to negotiate far more aggressively. And sometimes the right answer is the buyer decides to keep renting. I know, I'm a mortgage broker. I'm supposed to tell everyone homeownership is always the answer. It isn't. If buying the house leaves you financially stressed every month, hoping rates will fall so you can refinance and breathe again, that's not a strategy. That's a gamble. But there's another side to that. If you can comfortably afford today's payment, you find the right house, you negotiate favorable terms, and you're planning to own it long enough for the transaction costs to make sense, then waiting indefinitely for a hypothetical mortgage rate has its own risks. Because nobody rings a bell at the bottom. If rates fall significantly, you probably won't be the only buyer who notices. Lower rates improve your purchasing power, but they can also bring competing buyers back into the market. So the decision isn't, are rates good? It's, does this transaction make sense for me today? There's another adaptation happening that doesn't get nearly enough attention. People are changing their homes instead of changing houses. Recent homeowner surveys have found large numbers of people choosing to renovate rather than move. And when you think about it, this makes perfect sense. Imagine you've got a $400,000 mortgage at 3%. You need another bedroom. You could sell your house, buy a larger one, pay transaction and moving costs, take out the new mortgage of around 6 or 7%, and dramatically increase your monthly payment. Or maybe you just add a bedroom, finish the basement, convert the garage, build an ADU, remodel the kitchen, or add an office space. Maybe you simply make the existing house work for the life you have now. That's another reason housing turnover can remain low even if people aren't completely satisfied with their homes. The house changes instead of the homeowner's address. And again, that's the market adapting. Hey friends, go ahead and hit that subscribe button for me. I'd really appreciate the support. So do sellers eventually have to lower their prices? Some will. They already are. Some won't. And some markets will adjust much more than others. This is where I think the national housing conversation gets dangerous. Right now, you can find markets where sellers dramatically outnumber buyers. You can find markets with price cuts everywhere. You can find builders offering enormous incentives. And you can also find markets where inventory remains tight and good houses still sell quickly. Nationally, we're sitting at roughly a 4.5-month supply of existing homes. But those houses aren't evenly distributed, and neither are their buyers. So I don't believe there's going to be one moment where America collectively decides, okay, houses are now 15% cheaper. Housing doesn't work that way. Instead, individual markets find equilibrium. One seller cuts by $30,000, another offers a rate buy down, another gives $15,000 towards closing costs, another takes the house completely off the market, and another gets 3 offers because their neighborhood still has almost no inventory. That's how the adjustment happens. Slowly, unevenly, and locally. And here's something else I think that gets lost when we talk about mortgage rates. A 6.5% mortgage does not affect every buyer equally. Imagine 2 people buying the same $500,000 house. One buyer is selling another property and bringing $250,000 of equity into the transaction. The other is a first-time buyer putting 3 to 5% down. They're looking at the same house, they're looking at the same interest rate environment, but they're experiencing two completely different affordability problems. The equity-rich buyer is borrowing far less money. The first-time buyer is financing almost the entire purchase. So when rates rise, leverage matters. That's one reason higher income households, cash buyers, and home buyers with substantial equity can continue participating while entry-level buyers get squeezed much harder. A few $100s per month can be the difference between qualifying and not qualifying, which means if transaction volume is going to recover without a massive decline in mortgage rates, affordability has to come from somewhere else. Price, seller concessions, builder incentives, income growth, smaller homes, different locations, more money down, or some combination of all of them. The mortgage rate is only one lever. And this is where I think buyers, sellers, realtors, and lenders all need to become a little more realistic. If you're a seller, the market doesn't care what your neighbor sold for 3 years ago. It doesn't care what Zillow once told you. And it doesn't care what you need to get out of the house. The market is going to tell you what today's buyer is willing and able to pay you. You can accept that number, negotiate around it, or decide not to sell. All three are legitimate choices. If you're a buyer, the market doesn't care that your friend got a 2.875% mortgage in 2021. That mortgage doesn't exist for you today. You can buy with today's numbers, change the numbers through negotiation, change what you're shopping for, or wait. Again, all legitimate choices. But make the decision based on reality, not nostalgia and not predictions. And if you're a realtor or a mortgage professional, I think we have an obligation to stop selling people the idea that some future market is going to rescue every transaction. Our job is to make today's transactions make sense. And if we can't, maybe it shouldn't happen. I don't think mortgage rates have to stay at 6 something forever for this market to change. They only have to stay here long enough for sellers to adjust expectations, long enough for builders to change what they're producing, long enough for buyers to change what they're shopping for, long enough for homeowners to decide whether to move or remodel, long enough for the industry to stop waiting for 2021 to come back. Because 2021 isn't coming back. Not because we'll never see a 3% mortgage again, maybe we will someday. But the exact combination we had then, ultra low rates, rapid appreciation, pandemic migration, massive stimulus, and historically unusual monetary policy was exactly that, an unusual moment in time. And building your financial decisions around the assumption that an unusual moment has to repeat itself doesn't make much sense. So maybe this market doesn't need to be rescued. Maybe it needs to reset its expectations. Sellers recognize that yesterday's prices isn't necessarily today's value. Buyers recognize that tomorrow's rate isn't guaranteed. Builders create products today's buyers can afford. Homeowners adapt the houses they already own. And slowly, the market finds a place where buyers and sellers can meet again. Because a seller can ask yesterday's price, a buyer can wait for tomorrow's rate, but today's transaction has to work with today's numbers, and markets can wait for a while, but eventually markets adapt. This has been your mortgage brief for the week. With that, I will leave you with this quote by George Bernard Shaw. Progress is impossible without change. For everyone watching, I hope you continue to find opportunities to learn and grow so that you can create better outcomes for yourself and for the people who have trusted you to serve them. My name is Mark, and I am the Gentleman Broker.